Hello, everybody, and welcome to lesson number 6 on the Academy of Financial Trading course. My name is Sean Fitzgerald, and tonight I'm going to be bringing you through building your toolbox as part of the technical analysis series. Now, just before we begin, if I can check that the sound is coming through with everyone. Just give me a yes into the chat box. Let me know everything is coming through loud and clear. Fantastic. It seems we are coming through clear everywhere. That is fantastic. Excellent. So, obviously, before we begin, as always, have to do our risk warning. As we do all know, there is some risk to be had in financial trading, but our aim is to mitigate this risk. Now, the thing to remember is that the risk isn't a bad thing. Being aware of the risk, knowing how to control it, that's what gives us the advantage. That's what gives us the edge. But it is very important that we are aware of it at all times. Okay, so going forward in tonight's lesson, we're going to be examining ascending and descending triangles. We're going to be looking at ATR, or average true range. We're going to be looking at some oscillators, and then we'll be finishing up talking about some Fibonacci retracements. At the end as well, we'll do a little bit of house cleaning, but these are the main things we're going to be looking at tonight. So, building your toolbox. Ascending and descending triangles, okay? They can allow us to see price pressure, which can assist in forming a directional bias. Now, when I say a directional bias, what do I mean? Directional bias means we think it's heading in a certain direction and will continue to do so, and we expect to see a breakout in that favored direction. Now, just because we expect to see and it's favored doesn't mean it's going to happen, so we don't take it as gospel, right? We react to either directional movement. However, we may favor one direction over the other and allow it a higher pip value because not all trades are equal. If something is more likely than something else, you're going to favor the slightly more likely outcome. So actions speak louder than words. Order flow is king. The volume of orders in a given direction dictates what we do. And this is something we're going to be looking at a lot now. So what does it mean to us if an ascending or descending triangle is happening? What does it mean to us if the market is going in a direction? What do we care about? What is important about it? When I'm asking you, I want an answer here. Just give me what you think it means to you when you see a trend. What does it mean you should do? Okay, Lawrence, I like your answer. Just profit. All right, see confirmation. Exactly, James. It doesn't matter what it means to us. We don't care. We're not here to find triangles. We're not here to find how the market is going to behave. We're just here to find opportunities and to make money. And movement can only exist when orders are being made. So we're going to see the decisions that are influencing these orders and what these changes make. So first off, let's talk about ascending triangles. Okay, so we all know the word ascending is basically going up. So it's a combination of diagonal support and horizontal resistance. Now, does anybody remember which is support and which is resistance? When I say support, am I saying floor or ceiling? Exactly, the floor supports your weight. So we have to remember that. So an ascending triangle is a combination of diagonal support and horizontal resistance. So there's our horizontal resistance, it's our ceiling, and a diagonal support coming up. Descending triangles, I'm pretty sure it's obvious they're just the opposite, which is a combination of a horizontal support and a diagonal resistance. So you can see here they've been named not for any clever reason, but just simply for what they are. An ascending triangle is a triangle that's kind of pointing up, and a descending triangle is a triangle that's kind of pointing down. So let's have a little bit of a closer look at ascending triangles. Okay, it's where you have diagonal support and horizontal resistance. Now, if we read into this a bit further, what is that telling us? What is this horizontal resistance, but more importantly, diagonal support telling us? What is it telling us over time? Okay, now, Luke, I wouldn't necessarily saying the price is going up, but the low is going up, okay? So what it means is bulls are gaining strength and not allowing the market to hit lower lows. So look at this black diagonal line. That is the lows going up. So whilst bears are trying to defend an established resistance, just trying to stop it, get above that, but the low that it's hitting keeps going up. So bulls are being more aggressive than the bears in this market and are more likely to prevail, which is what we're seeing by these higher lows. And normally, odds would appear in favor of an upside breakout because what's clearly on the far side of that. So the price goes up, it hits the resistance, and it comes back down again. But when it comes back down, it's hitting a higher low. Before, again, it goes back up. So we see the higher low happening here. It's a higher low than previously before the market rallies and goes back up. It hits the resistance again before coming back down to another higher low. Now, if it was to hit this X, which direction do you think it's going to go? Are we looking at a breakout that's going to go up, or are we looking at a breakout that's going to go down? So are we going long or are we going short? And Tom, you are spot on. We don't know. We can't be sure. So we wait for confirmation to enter through price action. It could just as easily go down here, smash that floor, come straight back down. Or on the other hand, it could also go up. We could have a breakout upwards. How do we know what's going to happen? Well, we don't for sure. That's why we put in our pending orders, but we know our rough resistance, we know our rough support, but we wait for confirmation. Right, so let's have a look at a little bit of an example here with a daily chart for US dollar to Swiss franc. Okay, we can see here an ascending triangle. We can see our support line. We can see our resistance line. And what else can we see more importantly? We can see the low being higher, but we see a breakout. Where do we see the breakout? We see it up here in the top right. So is this breakout obvious to everyone? Can everyone see where this breakout? Okay, right. So what we can see from these ascending triangles, and we'll also see in descending triangles later, is that as it gets tighter, as the price point gets tighter, it bounces this zone as you're getting to the corner of the triangle, you could almost call it. That's when a breakout is becoming more likely. All right, so this one is Microsoft, and remember we've discussed before that stocks can have are more likely to have gaps in them because as the market closes in the evening and reopens again, you can have some volatility in the market, you can have some changes. So you can see quite a big gap here in Microsoft. But why did that gap happen? Can anybody tell me? So it was 19th of October 2015, roughly. The Microsoft had a massive gap. And Barika first in. We don't care. Exactly, because we're not here to find out about Microsoft's dirty laundry. We don't want to know what Bill Gates wrote in his diary on that day because it doesn't affect us. What do we want to find? We don't want to find his diary. We want to find this beautiful triangle right here. So we have this ascending triangle. We can see the lows going up. We can see the resistance being held. And we see the breakout. And what happens after the breakout? A brand new ascending triangle happens all over again. So, a new triangle is being formed, a new opportunity has presented itself, and that's what we're looking for, opportunities. Now, when we get to this mark, the 25th of November 2015, we can see that it's at a roughly 54.54. If you were to make a decision here, do you think you would go long? Do you think you would go short? Do you think maybe you would do something else? What would you do here? Fantastic. All right. Guys, look at how much we've learned. 2 weeks ago, we had nothing but people saying go long and go short. Tonight, we have nothing but people saying wait for confirmation. We are starting to have the golden rule sink in. That's right, we would wait for confirmation. We think a breakout is going to happen here, but we can't be sure. So we wait for confirmation of the breakout, and then that's what we go with. Now, we were looking at ascending triangles. Let's have a look at their opposite counterpart. Again, it's just the other way around. It's a diagonal resistance with a horizontal support. Okay, this is where bears are gaining strength and momentum, signified by their selling at lower levels, while bulls are trying to hold a defensive support line. And in this market, the bears are being more aggressive, testing the support and achieving lower highs as they go down. Okay, now remember with the ascending triangle, it was a higher low, and with the descending triangle, it's a lower high. Again, odds would appear to favor a breakout on the downside, but that doesn't mean that's what's going to happen. Just because it usually happens that way and the odds appear to favor that doesn't mean we're usually going to go with that. All right, so again, just a quick example on the top right, we see the market coming down. It hits the support line that's been established and it comes back up. But it only comes back up to a lower high than previous because the bears are dragging it down again. They drag it down, it hits that support line before the bulls rally, bring it back up a bit. But again, the bears are stronger, so you have another lower high, even lower than the previous high. So it bounces down, and then we're going to decide here, as the triangle is getting tighter, do we want to go short or do we want to go long? What are we thinking? Excellent. I don't even need to wait. We will wait for confirmation. I know some of you are thinking all the answers are just wait for confirmation. I'm getting bored of this. But unfortunately, there are some people still saying going long and go short. And this really is the golden rule. So we really need to drill it in. Because just as easily as it could break out in a downward direction, it could also break out in an upward. So what do? We wait for confirmation to enter through price action. All right, so let's look at a real world example here. So here we have Brent crude. A daily chart again, right? And you can see where are the lows, where's going long and where's going short. So first, let's establish our floor or our support, and then we will establish our ceiling or our resistance, and we can see that this is a descending triangle. Now, can someone tell me where is the breakout point? At roughly what price did we see the breakout point happen? Can anybody? All right, yeah, so I don't want to be too specific, but yeah, it's around here. It's at around the 47 mark, okay? We saw it was a descending triangle, and we see a breakout in the downward direction. Now, what we do see is after this little breakout going down, it rallies. There seems to be this bounce around the 43 mark. Now, does anyone know why is there this bounce at the 43 mark? Okay. Now, Callum, yeah, we don't care. Exactly, we don't care. Now, what is a little bit interesting, and some people have pointed out, which is fair, is that if you look over to the left, we'll notice that it is a previous low. Roughly around the 20th of August, it had also bounced at around the 43 mark. So it could just be psychological. It could be the bulls just thinking it's not going to go below that again because that's where it hit its low previous, so they make it rally. But as interesting as it may be to us, it's not that important. That's not what we're looking for. We're not trying to find out the reasons why. We're just looking for opportunities. All right, so again, let's have a look at another real-world example with gold, which is, the XAU USD daily. So again, we're looking at a daily chart. In the top left, we can see our descending triangle. We can see our no-fly zone. And what happens when it breaks through the no-fly zone? When it breaks through the floor, we have this plummet straight down. And we can see that it is a huge plummet. Now, so this is a descending triangle. And we think, well, yeah, descending triangles, they will usually break out in a downward direction. But what do we see with our descending triangle in the bottom right? So only a few months later, we have again a descending triangle, but the breakout is in the upwards direction. So just because an ascending triangle or a descending triangle will usually break out in a certain direction, that is no guarantee to us. And we are trying to avoid as much risk as possible. We're trying to make intelligent decisions. So what are we waiting for? We're waiting for confirmation. And that's when we get involved in the market. All right. So again, we can see here the same graph again. I'm just cleaning it up a bit and we're going to zoom out. And what do we see? Well, we see this giant ascending triangle. Now, let's be honest. Who at the previous slide put up their hand and said, I actually see a third triangle? Was anybody picturing this third ascending triangle right in the middle? Okay, some people saying yes, some people saying no, but you can see it now. And what I would say to the people who didn't see it, who are saying no, don't worry, this is something that you're going to train your eye into. The more we get used to these graphs, the more we look at them and get used to them, we're going to see this far, far more. Eventually, believe me, all you'll see is ascending triangle, descending triangle, breakout up, breakout down. It'll be like that guy from the Matrix who sees the code but just sees what color hair people have rather than actually reading the code. We're going to be exactly like that, spotting breakout points like this in our sleep. All right, everyone can see the breakout point here in this ascending triangle. We have a breakout going down, and it goes into a descending triangle which has a breakout going up. So we can see just because something is expected to behave a certain way doesn't mean it will. All right, again, let's look at the euro and the Swiss franc. And we can see one established floor, and then we can see another established floor over here on the right hand side. Now, do you think that this established floor is giving us an ascending or a descending triangle? What can people see here? Exactly. We can all see the descending triangle. Exactly. Now, so we're getting to the point on the 9th of January, my birthday, funnily enough, where it's at 120. And are we thinking that it's going to break out up, or is it going to break out downwards? What would you do in this situation? You would wait for confirmation. Exactly, because you would be very smart, and because it was a descending triangle, some people would not have waited for confirmation. They would have thought, you know what, it's a descending triangle, look at that previous low, I'm going to go short. And look where it went. Rocketed up. Absolute huge jump. So, what's important to remember here is, wasn't right either way, we always wait for confirmation. All right, so the triangles are price patterns that show congregations of order flow and commitment. They show price areas where people are trading and where people are comfortable trading. Remember how much of this is psychologicals. They also indicate where certain participants may be in losing positions. This aids our trading when combined with entry orders and a robust and complete strategy. So remember, we're just building a toolbox, okay? These triangles are just one of our many tools. You don't teach a plumber how to use a hammer and then he's good to go. He has to use it in conjunction with nails and a saw and wood glue. You need all of the tools, and these are just one part. But remember, we must wait for confirmation. If you're going to get a tattoo on your hand to be a trader, W4C is what you want there. Always what you're going to be remembering. Okay, now let's move on to our next slightly different topic. This is our average true range, okay? Again, it's just a tool, and this tool is going to let us see a movement in price over a predefined number of time periods. Now, why is that something we would want to see? Why would you want to know how much the price has moved within a certain time period? If I said to you, if you came to me and you said, Sean, I want to know how much this price has dipped or risen or gone up or gone down in the last 2 weeks. Connor and Kevin both spot on. Volatility. Exactly. We want to see how volatile a stock is. How much is it shaking? How much is it flying up and down? So it's good to gauge probable movements over time. If something we're looking at, if a market we're looking at hasn't changed by more than 4 pips in 5 years, over the last 5 years, it's never gone up or down by more than 4 pips, what are the chances we're going to see a massive breakout in the next couple of days? I think the chances are high or chances are low. Okay, not zero, because again, we never know what's going to happen, but the chances are probably pretty low, let's be honest. But at the same time, if we're looking at something incredibly volatile, where the stock is just rocketing up and down thousands of pips per day, what are the chances that, it's going to have a breakout in the next week? Probably pretty high. Now, that volatility might be a good thing, it might be a bad thing because it might be too much, but it gives us more information, and we always want as much information as possible. It can also tell us what is conceivable or not conceivable within the current range of movement over a time period being analysed. And when I say conceivable, we're just looking at how realistic is it, how likely is it. It can also let us see changes in commitment as volatility increases and a move intensifies its directional shift. So we can see how a bit of momentum in a certain direction, how far it can push something, how much something can rocket or plummet in a certain direction. So knowing conceivable ranges of movement is a hugely important tool to have, just to know how much is possible. So how it's found, the average true range, is just the average of the high and the low over a fixed amount of time. So it kind of gives us, like I said earlier, the momentum of a market. Okay, so here we can see a market, and down here we have the average true range. Okay, so we can see here that it's currently at 14.102, but it's varied hugely. We can see down at the bottom where our average true range is being mapped. So this graph is mapping it for us, and it's showing the range between 0.2075 and 0.5002. So that is showing us the volatility of this going forward. All right, so it's giving us a value of 0.2305. So that is its average true range over, and I think here it's the last 10 days. So it's showing us the range. So we know that this can jump by 0.2305. So we have one marker at 0.20305 above and one marker at 0.2305 down below, because that shows us how much it can swing. Okay, this is the difference between the high and the low, including gaps and averaged. So what does that mean for us? Well, it can help us decide on the side of the stops. Do you think you would put, your stop order at these lines or below these lines or inside these lines? Okay, well, in terms of a stop order, so if we were going short, well, if we're going long and it goes down, if the stock was to go down, we would maybe put it just below. Now, it depends. You're just using this information as part of a big range of tools. You're not just relying on this. All right, so let's have a look at it a bit more, okay? What if you decided that it's a little bit too volatile and you wanted to go twice the ATR away? So you put your stop loss at twice the distance away, but you make your trade half the amount that you would have done initially, so you are risking the same amount. Okay, we can see here that is 1 time away of the ATR value and then twice away, and we could put our stop loss here, but we purchase half the amount, or we make the trade half the amount, and therefore our risk is the same. Okay, I can see a couple of people asking, what is the stop order again? The stop order is where you will leave the trade if it gets to that point. So say, for instance, we're deciding to go long at this point, 24th of November, even though we have no reason to because we can't see a breakout, so we wouldn't. But just if we did, and we were to leave, place a stop order on down there where you see near 13.65, that means if it went down to there, we would leave the trade. All right, it's just to protect our investment. Okay, now don't worry if this average true range sounds a little bit too heavy or you're not quite sure why we're using it. This is going to be covered in depth very much in lesson 9. Okay, I just want you to know this because, again, we're going to have so many different tools. There's going to be so many different things we use and need to get to know. This is just one of them. All right, next up we're going to be talking about something called oscillators. Now, it can be quite confusing, but it's quite simple. An oscillator is a technical analysis indicator that varies over time within a band. So up and above or below a center line or between set levels. And oscillators are used to discover short-term overbought or oversold conditions. Now, a lot of big technical words in there, but what is an oscillator? An oscillator is basically a measurement when looking at a market that gives you more information about it. Now, there are lots of different types. One of them is relative strength index. It's a technical indicator used in the analysis of financial markets, obviously. And what this is used for is to chart the current and historical strength or weakness of a market based on the closing prices of a recent trading period. Now, you don't need to know these off by heart. We're not going to be getting too in depth on them. But again, I just want to go over them so you're aware of them. Another one is MACD, or the moving average convergence divergence. Again, just used for technical analysis of market prices. There's the Williams percentage range. There's one called the stochastic. And also there's the commodity channel index. This one is it's actually grown quite in popularity recent, and it's a very common tool for traders in identifying cyclical trends, not only in commodities but also in equities and currencies. And it can be adjusted to the time frame of the market traded on by changing the average period. So what it is they're just all ways of measuring certain things within the market, depending on what you want to measure, what you want to see. All right, so they are banded between two extremities, attempting to gauge if a market is overbought or oversold. So top end is overbought. So, when you think of buying, you're thinking of going up, you're thinking of going long. So overbought is going up. And obviously the opposite, oversold, is going down. People believe that if a market goes into an overbought or oversold area, it has to reverse. Now, do you think that is definitely true? Okay, of course it's not true. Now, with a lot of things within financial markets, sometimes you will see self-fulfilling prophecies because so many people believe this has to happen, they take an action and they can have an influence on it. But by no way is this a rule. All right? It can also mean trending heavily cannot be relied upon as a standalone indicator. It works best in sideways markets upon confirmation of the same. So let's have a little bit more of a look at the RSI one. Okay, it's just intended to chart the current and historical strength or weaknesses of a market based on closing prices of a recent trading period. Now again, this all sounds very technical and confusing, but don't get too hung up on it, right? Because we're going to show you just very quickly how it's measured and what it influences, and how you would use it. Okay, so basically an RSI value of over 70 is considered overbought, and below 30 is considered oversold, and basically people think it's going to reverse. So if it goes up and hits 70, people think it's going to come down, so they start going short. But if it goes down and hits 30, they think it's going to rally, come back up, so people start going long. So there has to be some external reasoning combined with this indicator. You cannot just be relying on this as your trading style and just picking this. So let's have a look at an example here on the Dow Jones. All right, so we can see at roughly the 24th of August mark, you would buy as it had hit the oversold market, had gone down, it had hit the 30, and a bounce would have occurred. So we can all see the value of the 30, and a bounce would have occurred. Now, did a bounce occur when it hit 30? So, did the market rally once it hit 30? Yes, it did. Now, did the market suddenly come down when it hit 70? So in this example, we can see, yes, again, also correct. The RSI value hit 30, and then it went straight back up because the market was oversold. And then when it hit 70, it came back down because people thought it was overbought. Now, you don't need to know what's that a value of 70 or 30 of. It's just the RSI value. So don't worry. You just say the RSI value when it hits 70 or hits 30. Because if we went into trying explaining it, we'd be having a lot of letters, a lot of numbers, and all of our brains would be very sore and melted. So we don't need to know about that. We just need to know that in the RSI value, it is 70 and 30 are our markers. All right. So there is a little bit of an issue with them. Let's have a look here. All right. So here we can see that it has hit the 70 mark on the 28th of October. So on the 28th of October, it hit 70. We all think to ourselves, okay, we're using the RSI. It's hit 70. This means the market is overbought, and I am now going to go short. I am going to start selling. Okay. Would this have been a good idea? So I get to this point on the 28th of October, it hits 70, and I say, you know what, I'm going to sell. I'm going to go short on this because I'm trusting the RSI value. Well, no, that would have been really bad because we can see that it just went up the wrong direction, and I moved a 400 pip move going in the upward direction. Now, can anybody else see anything when they look at this chart? Is there anything else you can kind of see? Exactly, Connor can see it. Now, I don't have lines painted on this picture because I want you to try get used to seeing it without the lines being added in. But yes, we can see an ascending triangle, and in a way we can see a breakout. Exactly, people are starting to see the ascending triangles, right? So remember, we're using all of these tools together. We're not just using one or the other. We're using them all in combination to give us as much information as possible. You know, if you're playing Texas Hold'em poker, do you look at just your cards? Do you look at just the cards on the table? Or do you look at both and make a decision with all the information? All right, you look at both, okay? You think when Lionel Messi is running at a goal that he's staring at the ball on the ground as he runs? Is he staring at the goal that he's running at? Or is he staring at the people around him and all the players? Or is he looking around and taking in as much information as possible? Exactly, he's looking at everything. You know, if he was to stop looking at just one of the elements, it would make him a far worse player. But he takes all of them into account. He takes into account where the goal is, takes into account where the ball is at his feet, takes into account where the defenders are, where his teammates are, where the sideline is, absolutely everything. And that's what makes him so good. And that's how we're going to be looking at markets. We're going to be the Lionel Messis of trading. So again, here's another example where it might not have done exactly what we wanted it to do. So the RSI value hits 30. We can see the date there in early July. Now, would it have been a good idea to go long here? So it hits 30, meaning we think it's been oversold according to the RSI value. According to the RSI value, we should go long here. We should buy. It should go back up. So we buy at the breakout. And then what happens? No, it goes the opposite direction. We would have gone in the wrong way by a 3,500 pip move, which obviously would have been very, very bad for us. So yes, RSI can be a little bit of a useful tool to see some things in the market, to sometimes predict some moves, but you do not want to become reliant on them, because they are definitely not a steadfast rule. If they were a steadfast rule, then everybody would just be using them. That's how trading would be done, and it would be a very boring endeavor. Again, we can just see here it hits 70, and again, RSI say that when you hit 70, it's overbought, so the market should come down. But no, again, we see the opposite. It rockets up, and it continues to go up. We see these jumps up before it hits a new high up here. A bit of a resistance, comes back down. But what's important for us to note here is, what are we seeing? Can anybody tell me what are we seeing? I've given a slight bit of a clue. We're seeing a ceiling, and we're also seeing an ascending triangle. Sorry, I raced on a little bit. So we can see the ascending triangle. We can see the breakout in the ascending triangle. And that gives us a little bit more information. We could have gone short there. And then we see a new triangle begin using the same resistance, using the same ceiling. So again, remember, we're looking at all... Exactly. Thank you very much, John. We're also seeing hammers and dojis as well. So we're seeing all of these things. They're giving us so much information. And that's important to note. We're taking it all in. We're not just using one or another. Now, the next thing we're going to look at is Fibonacci's. Now, obviously, one of the reasons I got into trading is because I'm a massive maths nerd. And if you're a bit of a maths nerd, then you're going to know who Fibonacci is and how much fun you can have with his numbers. So is anybody aware of Fibonacci? You might not necessarily have to be a maths nerd. Apparently, art nerds are huge into him as well. A lot of Renaissance paintings. Tom says he's an engineer, and it's incredible how much you see of him. Exactly. How much you see of Fibonacci's numbers come up, be it in art, be it in engineering, be it in mathematics, even in nature, botanists will be very familiar with it. And it's basically, he noticed this number series that occurred in nature, it occurred in maths, it occurred in a lot of places. And this kind of diagram that we're looking at, the squares, are supposed to kind of show, right? So you have one tiny square, and then you add another square to make the length of the first square, and then you add one on to the length of both the squares, and you add one on, and you add one on, you add one on, you add one on. You can see how quickly it starts to grow. So you can see again the number series at the bottom starts to grow as well. Now, you don't need to know too much about Fibonacci. I don't want to drag him on or get you guys too bored, but he obviously applies in trading. Because people see these numbers, they see this mysticism to it, and it's a series of numbers which many assert relate to natural universal proportions, and the ratios arise from the numbers that we just saw. And like I said, it appears in nature. You see it on leaves, stems, flowers, broccoli, you'll see it there, cauliflower. Any kind of plant where you see a spiral or something building, it'll always be in a Fibonacci sequence, right? Now, why are they important to us as traders? They're important to us because so many traders globally use them as support and resistance areas. Basically, they apply ceilings and floors based on Fibonacci's numbers. Okay? Now, these are only interesting to us not because we believe they work, but because they're a self-fulfilling prophecy idea. Right? So many traders become so reliant on them, and so many traders then act based on these numbers that it does become a self-fulfilling prophecy. So this means that we are studying them so we can predict what the retail trader is going to do, because we know what they believe in. We know what they think is going to happen. They're obviously going to take actions based on what they think is going to happen. And what can we do if we know what actions they're going to take based on what they're seeing and what we're seeing? Well, it allows us to make some predictions in the market. So obviously these are very, very potential areas of huge interest to us. Now, the Fibonacci levels that are used within trading is 50% is the most popular level. And then after that, you have 38.2% and 61.8%. And these are measured from a low point to a high point in uptrending markets and the opposite in downtrending markets. All right, I'll explain that a little bit more as we look into it now because I'm going to bring up some example. What you just need to remember is traders either range trade at these levels or trade the breakouts from these levels. Obviously, breakouts is something that we're very familiar with, that we like to look for because we see opportunity in breakouts, so we're looking for the same ones. So one can view Fibonacci's like envisioning support and resistance that congregations of traders have mentally agreed on. Okay, so it's a support line and a resistance line that just a huge bunch of retail traders have mentally agreed on. Whether they're aware of it that they've agreed on it or not, but because so many of them believe this 38.2 line, this 61.8 line, this 50% line, because so many of them believe that there is a real resistance and support line in these places, well then what happens? A support and a resistance line appears in these places. Because remember what defines the market? It's just human actions. So these actions that they're having do define the market. It affects it. So these are most important when other factors are also present, such as genuine support and resistance lines. We'll see all these things come up, and when they actually start, happening, and you see them happening very easily, it makes a big difference because all of these trades, all of these retail traders, their actions are affecting the market in a way that we can predict. And obviously, if you can predict the market, you are doing very, very well. Now, I'm going to look at this as a going up, as a going down. Because we can see where it is on the right hand side at the moment, it's going down. So my 0% line is at the top. And then as we go down, we have our 23.6, our 38.2, our 50, and our 61.8. Now remember, retail traders are usually more optimistic than pessimistic. Okay, so I don't want to say that that's a general rule, but usually. So it's something that we want to take into account a little bit. All right. you want to find obvious high and low points. So on this graph, the obvious high and the obvious low, very, very obvious to us. That red dotted line pointing it out. So we have our 0% and our 100%. And then we just break it up into the Fibonacci numbers. So we draw the lines across purely by the percentage. We're not looking at the graph at all right now. Okay? All we're doing is looking at the 0 and the 100, and then we break it into the Fibonacci lines. Now, when we've broken it into those Fibonacci lines, then we look and we see, is the market obeying it? Now, when you're looking at it and you see the Fibonacci lines, do you believe that the market is obeying these lines? Okay, well, yeah, to a degree we can definitely see it. Because if we start from the very top point, okay, so let's just look at recent times. So we look at the very, very top and we see that the market came down. It's coming down. It went straight through the 23.6 line. It went straight through the 38.2 line, but the 50%. At the 50%, it turned around. It turned around and it started going back up. And as it went back up, where did it bounce? Where are we seeing changes in direction? Again, yes, we're seeing changes at the 23.6. We're seeing it at a Fibonacci number. And then it starts to go down. And where do we see the change in direction again? Exactly, we're seeing it at the 50. And then where do we see change in direction again? We see it at the 23.6. But now the next bounce, as it's coming back down again, we can see that it's gone straight through the 61.8. So what I want you to think of it in a way is walking. You can just start off walking from somewhere. I'm at my office, I'm at my low point. Starting there, and I go to the restaurant, and I walk all the way to the restaurant, which is the high point. Okay, so I've walked from my office to the restaurant, and then I realize, I forgot my wallet. So I head back towards the office, and when I get halfway back to the office, my friend rings me and says, "Oh, Sean, don't worry, I have money for you. Come back here to me." I go, "All right, okay, well, I've only walked halfway, so I might as well come back." And then he rings me again and he says, "Actually, Sean, sorry, I forgot what terribly expensive taste you have and how unreliable you are with paying me back money. So I don't have any money. Better go get." I even go past the 61.8 line because I know that Greg is unreliable, won't give me any money, so I'm just going to keep going. And we get back there again, and it's given us a resistance line again. In this case being a support because it's reached its previous low, and we can take that as the line, but we're not going to make any actions on it. Why are we not going to make any actions when it reaches this line? Exactly, because we're waiting for confirmation. But it's still good of us to have this information, to have this line, to see what behaviors can come of it. All right, again, we're just looking at the example. Again, we can see the bounce off of the 50%. You can see the bounce off the 23.6. You can see it again at the 50%. So these behaviors are becoming predictable. Now, why are they becoming predictable? What is making these behaviors so predictable? Exactly. It's just people. It's just traders. It's belief. And as Jan and Antonius put it, we don't care. We don't care what's making them do this. If it's some cult that believes in the Fibonacci mysticism, if it's traders who just love numbers, if it's just somebody who likes rounding things up or down to these numbers, there are plenty of reasons it could happen, but pretty much it's just a self-fulfilling prophecy because so many retail traders believe that these are real areas of support and resistance, and because they act based on those beliefs. And as long as they do that for us, we can see here again, here's another example, again with the AU USD daily. Anybody know why it's called AU? Some people do, some people don't. It's gold, all right? It's the chemical symbol for gold, exactly. If you go onto the periodic table, it's gold. is AU, so we have the XAU USD daily, and here we're looking at the gold. All right, so again, we're starting at the top, or high point, coming all the way down to the bottom. We have our low point, and then we break it into the Fibonacci numbers in between. So you have your 23.6, you have your 38, you have your 50, and you have your 61. So we can see here the behaviors. Was there some, did 23.6 on its way down, did it act as a support? Was there some stopping there? Did people see a stop line there? All right, there was some support, not a huge amount, but we can see from the 6th of November up until the 16th of November, it did stay around there. It acted like a support. And then it came down, we can see that it went straight through the 38.2, went straight through the 50. They didn't act like any support at all. Same with the 61. So some of these lines were completely ignored, and it went straight through them without any support or resistance at all. But when it hit the 23.6, we saw that there was a little bit of a support, but it just went through it again. Now, in general summary, okay, we always need further confirmation, okay? We're not going to obey these lines as gospel. There are some retail traders out there that do it, but they are not the guys who are making money, right? The aim is to envision areas in the market where significant orders are located, all right? So we're just looking for a bit of action. We're looking for somewhere where a lot of retail traders are hanging out and might make a move. It just helps us to be ready by knowing where these areas are. And then if we see something, if we see the self-fulfilling prophecy happen, then we can act on it. That's when we get in there. Mark, I can see you saying there, would you more often use Fibonacci as a stop loss marker? Mark, again, not really. Again, you're going to be picking your stop losses based on way more than something than just a Fibonacci. We're going to be going into that far more in depth as we go on, talking about where should you put your stop losses in, why, based on what. And maybe the Fibonacci numbers will influence you because you've seen the market behaving like that. But we're going to be looking at how there's a huge amount of other stuff that you're going to be wanting to do when you're doing that. All right, poll time. Once again, we're going to look at a chart. So in trading, we must make decisions, but we can defer action until a future point. So you can decide something now, but you only take action on it later. All right. So let's have a look at this. Can anybody tell me what market are we looking at? I shouldn't have said who, that was a bit of a clue. What market are we looking at? Yes, we're looking at Yahoo. So we're looking at Yahoo daily. We can see here Yahoo is a stock. Again, it's quite volatile. We can see all these gaps. I know that it's been very, very volatile recently because all their investment in Alibaba. I was actually reading recently that they have now invested more in Alibaba than they are worth themselves, which is obviously huge, huge amounts of money, a lot of faith in Alibaba. But let's have a look at this, okay? So we can see some areas of resistance. We can see some areas of support. So let's have a look at where do we see our ascending or descending triangle. And then we're going to decide, are we going long, short, or other? Okay, so we can see an area of support here. We mark out our no-fly zone, roughly. Then we can see at the top, we see our area of resistance. Again, we're marking out our no-fly zone. And what do we see? We see our breakout area here. So we see a directional change in going down. So we're going short, we'll be going selling. We can see that it's going down. Now, again, remember even when we're seeing a descent like this, when we're seeing the descending, we still have a support and we still have a resistance marked here by the two red arrows. Okay, so we have a high that it's bouncing off and we have a low that it's bouncing off. So what would you do based here on where the price is right now and based on what we've seen? What would you do at this point? Okay, Stephen, I want you to have a think about that answer. Maybe type in another one. Yanette has it exactly. So some people just being nice and simple, typing in the W4C. But Yanette, Because I don't see a clear action yet. I don't see what's to do. I don't see confirmation of which direction I should go. It could just as easily go long or go short here because we haven't seen it break out of anything. So I know that I'm always giving the same answer, wait for confirmation, but we really do need to drill it into us. There is absolutely no reason to go long or short at this point. We cannot see which way it's going to break out, cannot see which way it's going. There is no reason to go long or short here. We just wait for confirmation. We'll make a decision when we have more information. All right. So the major concept is locating large congregations of orders, particularly of the least experienced traders, the retail traders. They're just trying to get rich quick. Their impatience is what's going to cost them. That is why we are always waiting for confirmation, because it's the impatient, get rich quick traders that lose all their money. Now, if somebody's going to make a decision to lose all their money, what do we want to do? Do we want to join them, or do we want to say to them, well, you know what? If you want to lose all that money, let me help you. Let me unburden you. I will wait here, and when you decide to make a rash decision, I will wait and I will help you unburden that load. Of course we are, because that's the intelligent thing to do. So if we can clearly envisage the stops of retail traders, then we can anticipate their larger players targeting those smaller participants, which helps us. So we need a full strategy for this. We've talked about your entry points, where you want to start a trade, your exit point, where you want to exit your trade, your position sizing, so obviously how many lots you want to get, or micro lots or mini lots, depending if you want more or less. Your portfolio selection. Remember, we don't care if we're trading Yahoo or Facebook or Mercedes-Benz or potatoes or bananas. We're not looking to trade cool stock. We're looking for opportunities. And how are we making money off of these opportunities? Through risk management. All right, so you guys are building up a pretty solid foundation. I can even remember from my first lesson with you guys up until now how much the answers have changed, how much the questions have changed. You might not feel like it yet, but you guys are definitely building a much better understanding. Okay, so Tom said it to you on one of the previous lessons. If you guys want access to the PowerPoint slides, that is no problem. We just want a small bit of feedback from you guys in return. So you visit the Shaw Academy homepage. As some of you may or may not be aware, it is our sister firm. It is the same owners that own the Academy of Financial Trading and the Shaw Academy. And we want you to have a look at the courses there, the selection of the courses. And if you have any suggestions for courses that you would like to see, we're just looking for you guys to give us some ideas. Get in touch with your email support manager, your program support manager. I'm pretty sure you've either heard from one of them in the past few days. The great team of lads out there. They're answering your questions right now through the chat box. They've been ringing you over the past few days, emailing you. So just send them an email and say, hi, I think course in, having an Irish accent, being as charming as Sean. Give me a course in that. That would be fantastic. Get one of them up on the site. God, I think that would sell like hot pancakes in a cold place. Something like that. And then they will send you out the PowerPoint slides, and brilliant. We're all getting along a lot happier. So if you can get around to emailing those into us, we'll then email you out the slides. Remember that the next session is tomorrow. Slight change in the timetable. Tomorrow we're going to be looking at a trading platform and practicing on it a little bit. And then in 2 days' time, we have the highly anticipated counter retail trading. This is the huge one, because remember, we've been talking so much about the retail traders, being the weaknesses there who we're going to pounce on. So this is where we're going to be looking at counter retail trading. So we've filled our toolbox with all the tools. Now we're going to start combining them and using them together. Also, it's where our competition winner will be announced. So you want to be there, because if our competition winner isn't there to accept the prize, we might decide to hand it on to someone else. So you want to be there for that. So make sure you're there for that. What I'm going to do is I'm going to quickly grab a drink of water like I usually do, because I've just been shouting at you guys for almost an hour now. But I would like to point out it's my first time finishing on time, which definitely improving. Thank you all very much for your attention. If anyone has to head off now, no problem at all. Don't worry. Don't forget, we'll be uploading the recording to your student area tomorrow. But for anybody else who's sticking around, I'm just going to grab a quick drink of water, then we'll do our question time. Thank you all very much. I'll talk to you all in a few minutes. Okay, and I'm back. So let's have a look at some of the questions. Um, can I ask how many people is in the contest for the prize? Massa, to be honest, I'm not 100% sure. We have to look up at the list of people. I haven't pulled the list yet, so I might be able to tell you tomorrow when I find out. But I don't know right now. Can you explain fly zone? So yeah, Gord, when we're looking at our floor and we're looking at our ceiling, so our support and our resistance. Remember this from lesson 5. It's not just one straight line. We're not just giving it a 100% defined line. If you break through this, that's it. That's a breakout. It's a zone. It's more of a zone, So it would be if you painted a really, really thick line along it. Or as you've seen in some of the graphs and some of the lessons we go through, we do 2 lines. So it's more of an area, a zone. So your floor is made of a zone. Your ceiling can be made of a zone. So your support and resistance is a zone. And we just call it the no-fly zone. And that's what we're looking for the breakthrough from. So it's not just a straight line. It's a zone. And the name we give it is the no-fly zone. If we just wait for confirmation, as lecturers say, when would we predict or make a sale or buy? So once a breakout occurs, what you do then is you follow the momentum of the market. So what we'll be looking at as we go forward is how you put in buying or selling orders based on the breakouts that we're looking for. So right now what we're doing on the course is we're just focusing on, the basics, on making sure you understand what a breakout is and how you would spot it. And then as we go forward, we'll start looking at, we'll start taking the next steps. But just remember, we have to get the basics down first. Can't just start suddenly throwing trades in. We have to understand what we're doing because we're trying to mitigate that risk. We want you guys to be successful traders. So you have to get the basics down first. And unfortunately, it's not something we can just learn overnight. It takes a bit of time. You have to educate yourself. But that's what we're working on. So don't worry. You'll get there. It just takes a little bit of time. Are Sean and Tom the same person? Glenn, no. But funnily enough, we have been told that we sound very, very similar. But no, we're not the same person. It would be very strange of us to pretend that we have 2 lecturers and then just the 2 of us do the exact same voice. But yes, myself and Tom have been told we sound very similar, but we are 2 different people, I can assure you of that. Sorry, let's make it up there. Yes, so there is, that's right. L, I can't tell what your first name is, it's just the letter L. But yes, there's 3 classes this week. That is correct. It is the only week that you will have the 3 in a row like that. We're continuously waiting for the confirmation to buy or sell. Then with which factor can we confirm or buy or sell? Like I said, Swati, we're going to be going forward onto that. So don't worry, we will be looking at that, but it is, we have to drill the basics into you first. Should you look at the triangles, etc., on a time frame that you are willing to watch and trade, or is there a standard time frame for seeing the confirmation? Donna, no, there's no standard time frame. The markets can sometimes move very slowly. They can move very quickly. What we do in general is we look at daily charts. But there are some traders that will move on far faster or far slower. We'll be looking at that further as we go along, but there is no hard and fast rule for a standard time frame. It depends on what market you're looking at. Some markets move very quickly, some markets move very slowly, and it depends exactly where you are, what you are doing, how much time you have. We'll get into that a little bit more in depth, but right now just remember, no, there is no standard time frame that you're just going to clock it in that. How far back is suggested to study the pattern in the chart? Nikki, again, it depends on what market you're looking at. There's no, I can't say to you, oh, you always look at the last 2 weeks. Because some markets are far more volatile, some markets are far less volatile. It also depends on what time period you're trading over, how much you're trading. There's too many things to take into account that for each different market, you have to apply new rules. You have to treat each market individually. You can't treat any two markets the same. So I can't, again, there's no standard answer like, oh, it's this amount of time. Will we be able to know how to use the MT4 platform? Nashat, yes, that is the platform we're going to be looking at because of how many people use it. So we will be doing a working example of that. Don't worry. Lalit again asking for ideal time frame for trends. There is no ideal time frame. It really depends on the market you're looking at. Where can we find Japanese candlesticks on certain stocks? Says that that depends on what platform you're using, but I will be showing you that later in lesson number 7 on how to use the platform, and we'll be showing you how to get the Japanese candlesticks and all that. Don't worry. So is it good to assume that the more volatile the market, the further we have to look back, or is it the other way around? In general, I would say yes, the more volatile it is, the further to look back. But again, that's not a hard and fast rule. Because what you're looking for is, you're looking for ascending and descending triangles. You're looking for your breakouts. You're looking for support and resistance. Sometimes you can spot it in quite a short period of time. Sometimes it takes a little bit longer. So again, there is just no general rules for these. If there was general rules, it would be far easier to do. You could just, you could teach your kid to do it for you while you go to work. But it takes a bit of work, it takes a bit of application because there are no general rules. So you have to apply the intelligence, try to mitigate the risk, make good decisions, and that's what we're trying to teach you. What is the confirmation we need to wait for? Is it the breakout? Alex, exactly, yeah. So what you're looking for confirmation is that it is breaking out with momentum in a certain direction. That is the confirmation we are waiting for. Can you say hi to my mate Pigott for attending his first lesson? Yes, Gavin, I suppose I can. Hi, Pigott, how are you doing? Will you show us how to get into the trading business in Japan and in other places in the world? I don't know if we're going to be going country by country specifically. We'll be chatting a little bit about different regions. But if you get onto your program support manager and have a word with them, they will talk to you a little bit about more specifics. How many platforms exist? Maria, I have no idea how many platforms there are, but there are a lot of them out there. Some brokers have their own individual platform. There's a good mix of platforms. So you have groups of brokers using the same platform. There's a lot of them out there. We're going to be looking at, one very popular one that lots of brokers use, which is why it's the one we use in the example, because, you can change broker and still know how to use the same platform. But we'll be going through one of them, but you can go out there and you can do some research and find one that suits you. Graham, trends and patterns are easy to spot after the event, not so easy to spot during a trading period. Does it get easier to spot patterns? Any tips? Graham, yeah, it gets easier with practice. We'll be, again, we're only 6 lessons in. This is lesson 6. We're only 6 lessons in. You've had 6 1-hour lessons. You're not going to just suddenly be able to spot these patterns immediately. It does get easier, but it takes practice. And before it also gets easy, you need to be aware of what you're looking for and what tools you can use to find it. I've only shown you some of the tools. There's going to be even more. You're going to see more measurements. You're going to see more patterns. We're going to see more things that give you clues. And all of these things, as you get to know them more and more, then when you have all of these in your head, when you're aware of all these things, makes it far easier to spot patterns. And then after that, it's just a matter of practice. Did we try calling you today? Shivan, it's very possible your program support manager would have tried to get in contact. If they did, they would have followed up with an email. So you check your email. There would have been a call saying, sorry, I didn't get through to you. I missed you, but here's my phone number and my email. We tried to leave it with you. So yes, it is very possible you got a call. So just check your email. But if we didn't get through to you, we'll try again. Mark, is there a follow-up course after this Fargation course? Mark, we do have another program after this, a more advanced one, but don't concern yourself with that right now. Let's focus on getting the foundation course out of the way, and then we'll talk about the advanced course or the Ultimate Traders program later. But let's focus on getting this one out of the way first. Is my support manager available at any time, or do business hours apply for calls? Lucas, business hours do apply, but obviously during lessons they'll usually be here as well. So if it's a bit into the evening, it depends what country you're in, I suppose, really. But yes, get in touch with us. They'll usually give you their working hours for you. In some recorded lessons, the sound is interrupted for minutes. Do you plan to do something? Maria, yeah, I wasn't made aware of that. If you send us an email with which recordings and where the sound is getting stuck, I can go in and I can edit that and I can fix it, no problem. Fixing the recordings is very, very simple. But I wasn't aware of that. So please let us know. If you've spot some issues, get in touch with us and we will take care of them. I suggested project management classes for the Shaw Academy. Ruzbeh, thank you very much for that suggestion. That is brilliant. If you said that to your support manager, they will be emailing you the slides, either this evening or tomorrow. Larry, are large broker firms better or worse than small firms to get with? Larry, again, you just can't apply a general rule to these things. It really depends on your situation. It depends on what you want to do. What I would say to you there, if you want to discuss that a bit more, definitely get in touch with your program support manager. You're going to want to have a proper long chat with them. And if they can give you some advice, but they need to know way more. They need to know what type of trading you want to do, how much of it you want to do, what your experience is, how you plan to go forward. And then they can maybe match something to you, give you some advice. But I can't give you a general rule now. It really depends. What colors are Japanese candlesticks in China? Shehzad, whenever you set up your platform and you set your Japanese candlesticks, you set them whatever color you want. I tend to use red and green because I find them very easy to spot that way. I find them very easy to read. But I have a friend or two, they use black and white. I have one friend who prefers black and white. I really don't like black and white because I think it is actually quite hard to read with how much is going on there. But you just use whatever colors you want. If you want to use, pink and orange, no problem. Go for it. So what color do they use in China? It depends on the person and what colors he likes. Will we get a glossary to familiarize us with those things not covered during the course? Yes, Carlisle, you will. If you just go to your student area, if you log in and you go there, there's a glossary already there. And it'll help you with terms and phrases that are used. And also, don't forget Wikipedia. Some people go to the Tradingpedia. Wikipedia, I think, is brilliant because Wikipedia is slightly better than the Tradingpedia in that Wikipedia is designed for non-traders. They assume that non-traders are going to be reading these things, so they explain them in slightly nicer ways. So I think Wikipedia is great to go. If you're unfamiliar with some terms or some principles, have a look there. They explain it very well. But there is the glossary inside your student area when you log in as well. Okay, Daniel's saying that the sound issue is based on your own internet speed and stability. If you rewind when a blank is heard, you will hear the sound the second time round. I'm not sure if that's sure, Daniel, but it might be a good piece of advice, but we'll look into it. We're definitely going to have to look into that. Not many more questions coming through. Do other types of traders look at CR traders like they don't know what they're doing as we look at retail traders? Uh, Gavin, it's hard to think how other traders look upon other traders. What you will find is that obviously each trader doing their own thing believes that their way is the best way. It depends on their level of success, depends on their level of education, how much they've trained themselves. So I can't tell you how they look at people, but obviously they think that what they're doing is the best way. Tom, how do you decide to start with 100% at the top or the bottom when doing Fibonacci? Tom, depending on which direction it's going in. So if it's heading downwards, your 0% will start at the top. If it's going upwards, your 0% will start at the bottom. Because you want to see where it's heading towards, and you want to set those resistance and those support lines depending on which direction it's going in at the time or it's trending towards. Will you explain to us how to manage risk in mathematical equations, or is it a descriptive course? It is more of a descriptive course, but I will tell you the principles on the mathematical equations that we're using. Such, for instance, when we were looking at RSI, if you want to go look up the mathematical equation for RSI, you'll find it instantly in Google, or you can go to the Wikipedia page. The mathematical formula is there. You can have a look at it if you want to, no problem. Abraham, what combination of tools are best used to obtain a confirmation to place a trade? Abraham, all the tools we're going to be looking at. That's exactly what we're trying to do. We're trying to build this toolbox that will let you find confirmation, which is why we're constantly telling you wait for confirmation. We're going to build that toolbox for you, and we're going to show you how to use it. So that's what we're doing. Is it a problem that I can't make the practice trading lesson live tomorrow? Daniel, obviously we'd prefer you to attend live. We think you get more benefit if you attend live. But if you can't, don't worry. The recording will be put up in your student area. You can access it then. What happens when different tools contradict each other? Rudolph, yeah, you're going to have cases where that happens. We saw it earlier. We saw the RSI saying that we should go in one direction, but our ascending or descending triangle told us we should go in another direction. But that's why we waited for confirmation. The tools are giving us ideas and they're giving us help and they're letting us prepare, but we're not taking action until we have confirmation. So when different tools are contradicting each other, just wait for the confirmation and then go with that. Just remember, the tools are just guides. Our decisions are made based on confirmation. Where can I find my PowerPoints? I sent a training recommendation in, but can't seem to find where the PowerPoints are. Tony, they should have been emailed to you by your program support manager. If you haven't got them yet, maybe double check your spam or your junk mail folder, or double check that your program support manager did get your email. So you should know who your program support manager is. They should either have spoken with you on the phone. They've definitely emailed you at this point. Just get in touch with them and see if you can get anything. Not sure if you can see my questions, James. I can. Did we discuss the MACD? Mark, no, there's a good few oscillators out there. We're not going to go in depth into all of them because I was just giving you an example. If you want to read up on them a little bit, again, Wikipedia, fantastic. But we're not going to go too in depth on those. We're going to be focusing on other areas. When is the final exam? Is it many days after lesson 1? It is. We'll be releasing it the day after. Sorry, not lesson 1, lesson 10. It'll be released the day after lesson 10. You'll be able to access it then. When examining RSI, for example, do you need to apply a time frame relative to the trading period you're trading? Is it important? Graham, what we're going to be doing is usually dealing with daily. Okay, like I said earlier, now it depends on the type of trader and the market you're looking at. Some people like to trade a little bit shorter, some people like to trade a little bit longer. We're going to be dealing generally in daily and looking at examples with daily. And we recommend that you start off with daily because it's a good way to learn, it's a good way to practice and to start. And then as you get more advanced, you can decide if you want to up that or not. But to start with, we're just going to be doing daily. On some of the triangle examples, it looked as though there were breakouts happening before your example breakouts. How do we know which are the correct ones? Yeah, so Peter, remember we were talking about it earlier, how you will have false breakouts, these little mini breakouts, and they'll come back with inside the range very, very quickly. Now, that's why you're using, your stop losses and your pending orders. You're going to use them all controlled. Now, it's not 100% perfect or successful all the time. You are going to have some false breakouts that come straight back into the range. You're only going to have made it at maybe if you did or didn't make a tiny trade based on what you thought was a confirmation. But, what will happen is on these tiny false breakouts, you won't lose that much or you won't gain that much. And it's then when the big breakout happens and you follow that's where you're doing well in the trade then. I'm not able to attend the important one 2 days from now. Is it really bad, and is there anything I should do? Hakon, like I said earlier, if you can't make it, obviously we prefer you'd be there live, but if you can't make it, don't worry, you can catch up in the recording, and then if you need some questions answered or you need some help, you get in touch with your program support manager and they'll talk you through it. I wish I could pronounce that name. It's an incredible name. Vyacheslav. Hopefully I pronounced that somewhat correctly. Will we have a chance to try our hands on trading platforms tomorrow during the webinar or after it? Vyacheslav, very important, and I'm glad you asked. We would prefer that you don't practice during the lesson. Watch the lesson and try to take it in. Because if you have people who are trying to practice while the lesson is on, they miss things, they get confused, they get lost, and then, they just don't get the benefit of the lesson. So, very strongly recommend practice immediately after, but watch the lesson first. Just watch the lesson fully. Have your cup of tea, your cup of coffee, your glass of water, whatever. Just watch the lesson, go through it, and then afterwards you can tinker around and play as much as you want to your heart's content, and we'll help you out as well then if you need any help. Will the slides be available for all the lessons at the end of the course? Daniel, yep, no problem. Get in touch with your program support manager. We send them out, no problem. That's Paul. Yes, there's only 6 so far, so we can send them out. How many exam attempts am I allowed? Paul, don't be too worried about the final exam right now. We'll discuss that all as we get closer to it. It is generally only 1 attempt for the final exam, but don't worry, we'll talk about that plenty more when we get used to it. Closer to it, I should say. Will we access the platform via our student area? We'll show you all of that, don't worry. That'll be done during the lesson. Is there any good trading book you could recommend? John, yeah, we have a recommended a recommended reading list, which I suppose is a leading list of authors. So that was a kind of nice faux pas to slip in there. But yes, in your student area, or you can get in touch with your program support manager. Again, it depends slightly what you're looking for because, it depends on what area. But we can have a chat with you about that. Okay, guys, it is almost gone the 20-minute mark now, and I do have to let the lads get home to their families because they get a little bit upset at me when I drag it out too long and keep everyone here. If I didn't get to answer your question live on air, I am very, very sorry, but please do email us at either support@academyft.com or email your program support manager if you have their email address. Preferably your program support manager, because then you'll get dealt with by them immediately directly, where if it goes to support@academyft.com, it has to be sorted out first, and then they'll get in touch with you. But if I didn't get to you, I'm very sorry. Please email us, get in touch. We'd be happy to answer your questions. As usual, thank you all very much for your attention this evening, for your attendance, and for partaking in your interaction. It was very great. I'm really glad I enjoyed it, and I'm glad to see all the people saying that they enjoyed it as well coming through. And we'll talk to you all tomorrow. Okay, take care now. Bye-bye.